Welcome back to Fibonacci's Trader. Today, we're zeroing in on SoFi Technologies, which has taken a significant hit, dropping more than 10% at the start of the year. For those unfamiliar, SoFi is a digital financial services platform that provides a range of offerings, including personal loans, student loan refinancing, mortgages, investing, and banking. Their goal? To offer consumers a seamless, all-in-one solution for managing and growing their money. The primary reason for today's decline is a recent downgrade by analysts, who argue that SoFi's current valuation is overly inflated and its financial targets overly ambitious. This particular analyst set a price target of $8 per share, less than half of SoFi's current price. While there isn't any groundbreaking news driving this decline, downgrades like this aren't new for SoFi, a company that often faces skepticism from analysts despite its performance. Looking back at the company's most recent quarter, SoFi delivered impressive results. Membership and product growth continued at double-digit rates quarter over quarter. Revenue for the quarter grew by an incredible 30% year over year, and their EBITDA margin reached 27%, the second highest on record. They also achieved $186 million in adjusted EBITDA, a company record. Even more impressive, SoFi turned a net income of $214 million on a trailing 12-month basis, marking a historic milestone as it shifted into profitability. This trend of outperformance has been consistent, with SoFi exceeding its own guidance on multiple occasions. For instance, Q3 revenue of $689 million came in above their high-end projections, and adjusted EBITDA of $186 million outpaced expectations by $21 million. The recent Fed decision to cut interest rates by a quarter point is also a potential tailwind for SoFi. While only 2 more rate reductions are expected this year, lower borrowing costs will likely make loans and credit products more appealing to consumers. For SoFi, this could drive higher demand for its financial services, boosting revenue and profitability in the coming quarters. Despite today's drop, it's worth noting that SoFi's stock is up 44% over the past year, trading at the upper end of its 52-week range. Analysts are mixed, with Seeking Alpha assigning a buy rating, while quant ratings hover near hold territory. Still, SoFi's historical performance shows strong accuracy in meeting or beating forecasts, with a perfect track record over the last 4 quarters. Looking ahead, SoFi's growth story remains compelling. Analysts expect 2 of the next 4 quarters to deliver triple-digit growth, with the remaining quarters still showing robust double-digit increases. The company has a proven ability to exceed expectations, which is evident from its 100% accuracy in quarterly beats. However, the forward PE ratio for 2025 remains a sticking point, estimated at 55, a premium compared to the sector median of 12.5. This high valuation underpins some of the bearish sentiment driving the $8 price target. Even so, some might argue that this target undervalues SoFi's long-term growth potential, especially given its track record and expanding market opportunities. Insider ownership of SoFi sits at around 2.6%, with insider sales totaling $553 million over the past year. While insider selling often raises concerns, it's important to note that such transactions are not always a bearish signal, as they can occur for personal financial reasons. On the institutional side, the story is more optimistic. Institutions have been net buyers, with significant purchases outpacing sales. This trend continued into Q1 2025, reflecting growing confidence among large investors in SoFi's long-term prospects. SoFi's financial health has improved significantly over recent years. Although free cash flow has been negative historically, the company is expected to turn free cash flow positive over the next 12 months. Additionally, net debt to EBITDA has dropped to 1.4 on a trailing 12-month basis and is projected to decline further to 1.1. This demonstrates a strong and improving balance sheet, with total debt halved from $6.6 billion to $3.3 billion over the past few years. SoFi's top-line growth remains impressive, with trailing 12-month revenue hitting $2.5 billion, a 4-fold increase from $510 million in 2017. However, share dilution has been a concern, as the company has consistently issued new shares to fund growth. While this is less of an issue if SoFi continues to outperform the S&P 500, it's a trend worth monitoring for investors focused on long-term returns. Using a DCF model, SoFi's intrinsic value is estimated at $18 per share, suggesting a 31% upside from current levels. Even with more conservative growth assumptions, such as an 8% annual rate, the stock would still warrant a value of $16, higher than the current analyst price target of $8. For investors with a long-term perspective, SoFi's potential to grow into a company comparable to PayPal is worth considering. If it reaches a similar market cap, SoFi's future stock price could hit $71, representing a significant upside. Final thoughts. SoFi is undoubtedly a high-growth company with strong financial momentum, but it trades at a premium valuation that reflects this potential. For long-term investors, the current pullback might offer a buying opportunity, especially if you believe in the company's ability to sustain its growth trajectory. Let us know your thoughts in the comments. Are you buying on this dip, waiting for further declines, or steering clear of SoFi altogether? Don't forget to sign up for our free weekly newsletter for insights on undervalued stocks and market updates. As always, thanks for tuning in. I'll see you next time.